Welcome back. You're watching Commodity Champions. We continue our discussion on gold for your portfolios. Joining me now is Feroze Aziz, Deputy CEO at Anand Rathi Wealth, and Lakshmi Iyer is CEO of Investment Advisory at Kotak Investment Advisors. Thank you so much for joining us. And I hope you heard the conversation that gold prices are headed higher from here. That's exactly what Saxo Bank feels, that $2,100 per ounce is what we could be looking at in the international markets there. Feroze, hi. One thing, if you look at the last quarter, the last year also for that matter, we've seen gold outperform. It's given a lot of good returns as compared to other asset classes. When it comes to gold, what is, the first question is quite basic now. Do you need gold in your portfolio?
Hello, Manisha. In my opinion, yes, gold has some merit to have in one's portfolio because of its usages on three counts. One is, of course, a risk mitigation because equities behave not precisely like how gold behaves. That's one utility. That's to create a plan B in your portfolio. The second utility is to create dollar accumulation over the long periods from a personal finance standpoint. When you have education of children abroad or any other global goals which will require dollars, it's a great mechanism to accumulate those dollars. So these are the two primary purposes one can have a portfolio constituent in the form of gold. But now let me try and look at risk mitigation and see its mathematical merit of its inclusion from a risk standpoint. So if you look at the last 4-5 years, when you look at the peak to trough of Nifty, if you look at FY21, when Nifty fell from April 30th to May 18th, it fell about 10.5%. What was this return of gold in the same period? Gold was 3% positive. So similarly, if you do it for year after year and see when Nifty fell the maximum, peak to trough, did gold deliver you a positive return? If it so did, one tick mark that it, in one measure, it is actually a risk mitigant. That's point one. So 4 out of 5 years, if you look at it from FY21 backwards for 5 years, when Nifty fell from peak to trough, the maximum for that financial year, gold actually delivered positive returns 4 out of 5 times. That's one way of measuring its utility in the form of risk mitigation for the portfolio. And if you look at the correlation between equity and gold, mathematically, there's a formula which helps you derive the correlation. The correlation is negligible. Hence, it also says that equities and gold may, as a combination, as well complement each other.
Oh, well, absolutely. So, Feroze, there are so many theories going around on how much of your holding in sense of percentage of portfolio should be in case of gold. I mean, I understand it's 5 to 10%, and some people have been even more excited calling it 15% as well. But would you say that we should keep changing our short-term and long-term goals or portfolio for that matter in a year where we do understand that there is uncertainty? We're talking about recession. We're talking about equity markets being choppy and perhaps on the weaker side as well. Should you be increasing gold then, even if it's for the short term?
Yes, I completely agree that the dynamism with respect to gold allocation has to be higher, mathematically, again, provable. That in equity, you might have more static allocations, but gold, you need to know when to exit as well. Now, like if you look at the last 3-year return, it's 17%, 17.5% CAGR. But equities on a 3-year basis have delivered 40-50% CAGR because we are speaking 3 years exactly from when COVID broke out. So point I'm trying to make is 1-year return, it has beaten all asset classes hands down. And Manisha, I remember you having called this long before it transpired. So if somebody could look at your show and then decide when to enter and when to exit and creep a primary allocation of 5-7%, a tactical allocation of 8-10%, that's when 15 becomes a number which is practical. Otherwise, if you don't have the capability of tactical allocations, then a 5-7% strategic allocation, which can be static over long periods of time, is meritorious.
All right. Feroze, would you say that Indians, as per se, when you talk about portfolios, are underinvested in gold? I mean, we do understand that every household has gold and we look for opportunities to buy gold. I mean, you as per se may not have gold in your portfolio, but I'm sure somebody in your house has bought enough and more gold there. Would you say in that sense, in that financial sense, we still are underinvested?
You're absolutely right, Manisha. If you look at how we have imported gold over the last couple of decades, we have been one of those countries which have almost contributed to the imports of the rest of the 195, leaving the top 5 aside. So, point is, yes, from a physical gold standpoint, we have gone overboard. And I think if you look at the GDP to the ratio of our GDP to the gold consumption we have had, we are the highest in the world. So physical gold, yes. So I might have my mom stacked up a lot of gold bars, but financially we are underinvested. But the good part of financial investment is the fact that you can have different vehicles. I think if you know that these three vehicles, gold fund, gold ETF, and sovereign gold bond, why each of these are relevant and to who and for what money, if that jigsaw puzzle can be solved, I think that's when we break the shackles of not having gold in our portfolios from a financial standpoint. And you guessed it precisely right. I don't have gold, but as a family, we do.
Yes, absolutely. You know, I've seen so many people lament saying that, oh, gold is the only one that gained, and oh, that's the only thing I did not have in my portfolio. So, well, yes, I've been hearing that a lot of time. But do you wear any gold, Feroz?
No, I don't. I have to shed the bling, so I've not worn gold as an ornament lately, for sure.
Okay. As you said, there are so many ways to buy gold if you want to include it in your portfolio, the financial asset, if you want to treat it like that. What would you say is the most cheapest or the best way to have gold or best way to own gold for a short-term or a long-term portfolio?
See, if there's a viewer listening, he or she needs to ask themselves, do they have money to buy a gram of gold at once? If they so do, then gold ETF is a great alternative. If you don't and you want to systematically build a portfolio, today we have 14,300 crores of SIP money in equity. And if that's the kind of route you have and you don't have lump sum monies, then gold fund is your only alternative. And if you are a short-term investor, with a reasonable amount of money, gold ETF comes into pictures. The third is if you're a long-term investor and not looking at trading, which is the core part of the 5-7% we were discussing just a couple of minutes back, that portion has to be in sovereign gold bond because if you mathematically see, you're getting a 4% gift every single year. In the form of interest and the tax rebate of capital gains. It is the only instrument known in India which has zero capital gains still. Equities are now taxed. Of course, the debt taxation impacts the debt gold funds as well. So gold fund for retail, a lump sum short-term investment, gold ETF, long-term strategic investment, sovereign gold bond. And don't ever miss a free lunch because there are very few of them in the world of investing. And 4% per annum of extra return is unbelievable. And that's because you're wanting to align the country in terms of not physical but financial goals. And that seems to be your purpose as well, rightly so many times.
Oh, well, absolutely. You know, last year gold at same time was trading at 50,000. We're trading at 62,000. Add to that what you would have earned in sense of rate for sovereign gold bond as well. And you're sitting on a very happy chunk of money there. But, you know, having said that, and Lakshmi, this question is to you, even as sovereign gold bonds seems to be the place of choice when you want to buy gold for a longer term, it's just about 100 tons of kitty, and that too over the period of 6 or 7 years. And, you know, it doesn't even come at the most opportune of times. Whether it's Akshaya Tritiya or Dhanteras, we do not see a tranche coming in. So it's not, when you make those calculations, perhaps it's not so profitable to the government either, is the reason we're looking at that small amount and very limited tranches. But what's your sense? What would you say is the best way to buy gold if you were doing it for your portfolio?
Clearly believe that, sovereign gold bonds, ETFs, any form of non-physical gold ownership is clearly the best way to own this asset class. But I would also maintain the fact that if you are looking at the taxation benefit, as Feroz rightly alluded to, post this index, incremental interest, going into the sovereign gold bonds. So yes, the need of the hour is to have more frequent issuances because the taxation advantage and clearly the additional free interest that you get, and that too, this is sovereign, right? I mean, nobody can really stop you from getting that. One caveat here obviously is that you're compromising on the liquidity, but I think that's not a material showstopper because we clearly believe that gold has to be clearly a tail end allocation to your portfolio. Come what may, even if gold doubles from here, it's absolutely okay. It's not a financial asset class. It's just a term risk or a term insurance cover to your financial portfolio. So go for sovereign gold bonds and a combination of gold ETFs if you don't have the sovereign gold bond.
Lakshmi, when was the last time you bought gold?
You asked Firoz the question, do you wear gold? You should have asked me that question because, I don't
You would
wear
have said
gold
no. I know that, but when was the last time you bought gold?
No, I know that, but I'm saying so I neither wear gold nor do I, buy gold. I have small investments in gold ETFs and I had done a small tranche in sovereign gold bonds, but that's about it. I think if you want a wealth multiplier, asset allocations clearly should be skewed towards financial asset classes.
And not wearing it. I get your point. But this is a question I want to ask both of you. And when we talk about commodities and we talk about portfolios, gold is just the starting edge there. I mean, there are just so many commodities which have seen such volatile moves and have given such great returns. Would you say, and this one is to you, Firoz, would you say that India is, still beginning to get into commodities when it comes to a portfolio?
Yes, absolutely. You're so right. Like if you look at silver, for years and decades, we didn't have a silver ETF. Of course, silver lagged behind. Now we have a few silver ETFs. So I think unless you make a commodity financially easy to buy, logistically easy to buy, cost efficient, less management, uncomplicated, it's not possible to make it a financial instrument. But does only gold deserve to be a financial instrument in people's portfolio? The answer is no. But silver certainly does, having stood the test of time. Of course, there are other hard metals which people don't understand, but silver and gold, I think every household understands. So I'm very happy that ETFs on silver have started. And expecting a retail investor to use MCX to go long on silver and roll them over for 5 years is like a practical impossibility. So that's point two. I think we take one step at a time as a country. So silver should definitely be embraced. Unfortunately, if you look at the risk of silver in terms of standard deviation, that's twice more than gold. So a person who buys silver needs to understand that the risks are twice more than gold. So your exposure of 5 rupees on gold would imply from a risk standpoint 10 rupees on silver. So as long as an investor is able to understand and comprehend this, I think they're good to go with the silver ETF as well.
My question really is on why would not investors understand this? Because as you mentioned, gold and silver is just one starting point here. Copper, nickel, aluminum all hit all-time highs. And we've seen 30 to 40% of move come in last 12 months itself. Not just that, cotton, corn is something that international markets make such huge money on. These commodities also hit an all-time high. Currently, orange juice in US is hitting an all-time highs, and we've seen huge volumes come in on this one. I mean, I'm still waiting on when would India start trading into all of these things. What's your sense, Lakshmi?
Manisha, I think orange juice futures and trading, etc., is still some distant dream as far as Indian manufacturing is concerned. But I clearly believe that, having gold and silver definitely have made the mark. You've started seeing assets under management gradually grow in the silver ETF category, which is the right thing to do because we're looking out of the recessionary trends gradually and looking towards capacity growth across the globe. And I would say, maybe as a start point, industrial commodities, base metals, and some of the select soft commodities where India has a reasonably vibrant futures market, not so much used by retail investors. To a lesser extent, I would say that would be a stepping stone, and I don't see that day very, very far away.
All right, I have 30 seconds to close this show, but if there was another commodity that you guys would want to trade in, what would be that, Lakshmi?
For me, it will be crude oil, Manisha.
And for you, Firoz?
I think I would stick to gold and silver.
All right. Thank you.
But all of us are.
Thank you so much, guys, for joining us today. Lakshmi and Firoz for taking us through that interesting conversation on what should and shouldn't be part of your portfolio. And if yes, on how should you be including commodities there. With that, it's a wrap on this edition of Commodity Champions. Thank you for watching.